If you had $500,000 to put into an annuity, would you choose a 5.5% guaranteed rate for 10 years or a guaranteed paycheck for life? In this lesson, we'll compare both side by side using annuity software to help you see which one best fits your retirement income plan. If it's your first time here, I'm Dr. Amanda. Welcome to the Retirement Income School. This is your place for financial education to learn how to protect your wealth and generate guaranteed lifetime income so you can retire financially relaxed. All right, let's compare a $500,000 annuity, MYGA versus FIA. Just a little recap if you haven't been watching my other videos on annuities. A MYGA is a multi-year guaranteed annuity, and an FIA is a fixed indexed annuity with an income rider, is what we're comparing here for retirement income. And the goal in this comparison is for us to look at safe, guaranteed, and predictable income and look at the difference between using a MYGA or an FIA for retirement income. And what we're looking at here for a MYGA, the multi-year guaranteed annuity, is a fixed rate of 5.5% for 10 years. That's something that's available at the time of this recording, 5.5% for 10 years. This is protected. There's no market exposure. It's simple. MYGAs are very simple. So this is no fees. It's clean accumulation. You know exactly what to expect. And there is flexible withdrawals. So in this case, we're going to look at withdrawing interest only every single year. So you'd be taking that $500,000 and withdrawing 5.5% to supplement retirement income and looking at the numbers there in comparison to an FIA or a fixed index annuity. So an FIA with an income rider is going to give you market-linked growth. It's tied to index performance. Think of the S&P. You're not invested in the market, but you're tracking an index and it's tied and linked to that growth. There's also downside protection in an FIA. So there's no market risk. You've got principal protection. And if you're using an FIA with an income rider, then you're going to have guaranteed income for life. You want to think of this as a paycheck that you get for the rest of your life, no matter how long you live. So in this case, it's growth potential plus guaranteed income for life versus the MYGA, where you have a, let's say, 10-year contract, but you're getting 5.5% withdrawals to supplement retirement income. And then in 10 years, once that contract's up, you're going to need to rethink what to do for that supplemental income. And before we dive into each, let's look at a side-by-side comparison of the different features of an FIA and a 10-year MYGA. So the growth type. For an FIA with an income rider, it's going to be indexed, typically S&P based. Other options are available, but think of the S&P and how it's tracking the S&P. On a 10-year MYGA with a 5.5% growth rate, it's a fixed, guaranteed rate. It's contractual. You know when you sign that contract that you're going to get 5.5% on the $500,000 for 10 years, guaranteed. The income start date with the FIA that we're going to be looking at in this case, there's a 1-year deferral. We can also look at 5-year deferrals, 10-year deferrals, and what that does to the income. With a MYGA, you have immediate availability to pull the interest annually for the entire 10-year term of the contract. With both an FIA and a MYGA, you have principal protection. What that means is that you're never going to lose money. Now, with an income rider on an FIA, you are going to draw down the principal over time as you're getting paid that guaranteed lifetime income. So let's say you've been paid 20 years on an FIA for income. Well, there's no principal left, but they're still paying you an annual amount for the rest of your life, and you can never lose. As you're growing the income, let's say you're deferring on a $500,000 FIA, well, you're growing in a protected way because you can't lose money in an FIA because there's a 0% floor. And if the market goes down, you're protected at that 0% floor. With a MYGA, you've got complete principal protection because all you're doing is drawing the interest, and your $500,000 is what you're drawing the interest on. And at the end of the 10-year term, you're going to be returned the $500,000. So you have principal protection in that way. Fees on each of these. Let's compare the fees. With an FIA and an income rider, riders on these annuities are going to be around a 1.25% fee. Some are 1%, some are 1.5%. So we're just going to say for now it's about a 1.25% fee. What that rider does is gives you guaranteed income for life. If you want to learn more about fees, go back to my lesson that talks about annuities and fees, and it dives into the differences in annuities and the fees. So FIA has a fee for the income rider. MIGAs, no fees. So you're putting your 500K in, no fees. They're letting you draw interest, or you can let the interest grow in a tax-deferred way. Comparing these two in terms of liquidity, like I said, with a MYGA, you've got access to interest, and some MYGAs will let you withdraw up to 10%. So you've got some liquidity there. In an FIA, you also have the availability to withdraw. Often it's 10% per year without any penalties. When we're comparing these two, the FIA with an income rider and the MYGA for income type, the FIA is going to give you guaranteed lifetime income, and the MYGA is going to give you interest only, or sometimes up to 10%. Now, keep in mind, if you have a 5.5% MYGA and you're withdrawing 10%, well, then you're drawing down some of your principal. So if you're wanting to use this as an income strategy where you want to keep your principal protected, then you're going to want to have a MYGA that lets you withdraw interest. You could have a 10% liquidity feature just so you have access to extra capital if you want it. But if you're using this for principal protection with interest only withdrawals, you only need a MYGA that lets you access interest penalty free. So an FIA is going to be best for lifetime paycheck, guaranteed income for life, and a MYGA is going to be best for the simplicity, you knowing the exact amount that you can withdraw each and every year, protecting that principal base so that at the end of the contract, you pull that full amount out and do what you want with it next. All right, so let's get into the comparison using annuity software. We are going to use a 65-year-old couple who is wanting supplemental income. They have $500,000 of capital to use for this annuity, and they're just really needing reliable income starting 1 year from now. And they want it to be guaranteed and protected. So we're looking at the FIA with a 1-year deferral, turning it into lifetime income. We're looking at a MYGA, a 10-year term, 5.5% interest only income. So first, we're calling this case study Sam and Sally Sample. They live in Colorado. They have $500,000. We can say this is any type of funding. You can purchase an annuity with a traditional IRA. You can do rollovers. We can use a TSP, non-qualified money. There are a lot of different options. So for now, we're just going to say any funding. And we're going to check enhanced payments and no income reduction. What that does, the enhanced payment is going to give you a multiplier of the income based on long-term care needs. So a lot of times this is called a doubler. In a single income, it's going to double your income. In a joint, it is typically 1.5x. And so I like to have this option on an FIA annuity with an income rider because it gives you a little bit of extra protection in case you have a long-term care event. Now, in this case, we're going to say that they're both 65 years old and that they're taking joint income for life so that they're both protected. If you were to take a single income, these amounts would increase. And let's just look at what I'm talking about. So right now we're saying this is a 1-year deferral on $500,000, and this is a joint income for both of them age 65. And you see here that the top carrier is giving them a $39,000 per year income for life. Now, if we switch this to single, let's say it's just one owner. Now it's $44,888. And you see also how it switched carriers. So this software helps me to look at all of the different types of annuities that are available right now and their ratings and the outcomes of what we put into this software being, do we want an annual income? Do we want it to be a single or a joint payout? Do we want no income reduction and enhanced payments? And so we can play with a lot of the terms here. I just want to give you a quick overview to give you an example of what this looks like comparing a fixed index annuity with an income rider and a MYGA. So this one is an FIA, and let's say we're going to keep this as joint income because that typically makes the most sense in a partnership situation where we have two people who want to take the income for life. Now watch what happens when we defer this for longer. So again, they're putting in $500,000, and in this case, 1-year deferral, well, they're at $39,000 per year. Let's say they defer for 2 years. Now they're at $42,300 per year. Let's say that they defer for 5 years until age 70. Now they're at $54,374 per year for the rest of their life. Now let's just look at this 1-year deferral and look at an illustration for them. So what this is saying is that they're going to have a 5.86% lifetime withdrawal rate on their accumulation value for this annuity, so that they're receiving around $39,000 per year for life. And with this enhanced lifetime withdrawal, if something were to happen and they qualified for a long-term care event, well, they'd have $78,000 per year. And so that's what you're looking at if you think about 500,000. Now this is pretty powerful because we know about the 4% rule, where if you were to take 500,000 and you took 4% per year, you would have less and it wouldn't be guaranteed for life. In this case, they can withdraw 5.86% for life as a joint income for the rest of their lives, no matter how long they live. It just keeps coming and coming and coming. And you see here, they're running this out until age 95 and 96. Well, if they were to take that income for that many years, so that's 30 years, 66 to 96, let's just multiply that so you can see the power of this. So that's 30 years times 39,097. That's 1.1 million. They put 500,000 in and they're getting 1.1 million out. The likelihood of somebody living, one person in a partnership at age 65, the statistics of them living to age 95 are very, very high. And so in this case, you're protecting yourself against longevity risk and not running out of money. If you were to take this 500,000 and withdraw 4% per year, it might not last forever because you are subject to sequence of returns risk. In the case of an FIA annuity with an income rider, you're not subject to market risk because it's protected. Remember, we said it has that zero floor, so you're never going to lose money, and you're guaranteed to be able to take this $39,000 income for the rest of both of their lives on this joint income. Okay, so let's just write that number down so we can keep it in mind. We've got 39,097. And that's what that couple would receive for the rest of their lives. Now let's compare this to a MYGA, the multi-year guaranteed annuity, where they're going to put their 500,000 of principal in and only withdraw interest for supplemental income. All right, here we talked about a 10-year term. So let's only look at 10-year terms for now in MYGAs. And right now what we've got is 5.5%, 5%, 5.05. So let's just look at this 5.5%. This is interest only access. And let's consider ratings here just so you understand. A ratings, you're typically looking at companies that have been around for a long time, some over 100 years. And in B ratings, you might be looking at a company that hasn't been around as long but has good standing, and you want to pay attention to the ratings. In this case, Equitrust has 2 A- ratings and a B++. They've doubled their assets in the last 10 years in the billions. Very safe company. I use them all the time. And when you're looking at annuities, you really want to look at the company profile and just make sure that you're making a good decision. Sometimes companies that are B rated, let's say B-, B, they're going to have higher rates, but they might not have been around as long, and you might not feel comfortable putting your retirement assets in that company. So definitely ask questions from the agent that you're working with, why they have that rating, and do your due diligence to understand the safety. Again, like I said, I use Equitrust all the time. Incredible customer service. They're growing. They have a very diversified portfolio. So I allow this company in this case to show up on the comparison for MYGAs. Now here, what we're looking at is a 5.5% interest only over the course of 10 years. So let's look at how this plays out. So if you were to put $500,000 in to this specific MYGA, you've got 5.5% that's compounding annually, and you would just keep growing and growing and growing it. If you weren't taking out any interest, then at the end of the 10-year term, your 500,000 would turn into 854,000. What's unique about MYGAs is that if you're using them as a safe growth strategy, the growth is tax deferred every year. So unlike, let's say, a CD where you have to pay taxes on the interest earned every year, you don't have to in a MYGA. So you can let that continue to grow and compound tax-free until you actualize it. So in the 10th year, when you take out the 854,000, you're going to pay taxes on the 354,000 of gain. In this case, we're looking at this as an option for supplemental retirement income. So here we would have $27,500 per year of income because it's going to be the same $500,000 base and 5.5% for all 10 years. And so you'd have $27,500 per year. What you would do in this case is if you want that $27,500 as a one-time payment, you would have your MYGA, put the 500K in at the end of the year, take the $27,500 out, do that again the following year and the following year, and that would be your supplemental income. Now remember on the FIA, we said we had $39,097 per year as a joint income. The difference being here that in the MYGA, when you're finished with this contract, you're just going to pull your $500,000 out that you put in initially as the principal. So you're protected. That $500,000 is always going to be there. The difference is now you have $27,500 instead of $39,097 because in a MYGA, it's not giving you a contractual guaranteed lifetime income. It's giving you interest every single year that you can choose to take out as an income or let it grow in a tax deferred way. So that's the difference between those two. And then a few variations here with this same company. They've got a 5% rate. If you want to do a 3-year MYGA, they've got 5.25 with a 5-year MYGA. And then it just goes up from there to 5.5% with the longest term being 10 years. All right, what do these numbers show us? They show us that both a MYGA and an FIA with an income rider are going to give you principal protection. You have zero market downside risk. So you're protecting yourself from sequence of returns risk. And this is really the safe bucket of your portfolio. A MYGA is going to give you a guaranteed yield. You've got steady interest income that you can access each and every year. And then at the end of the term, you just take back your principal that you put in, which was in this case, 500K. With the fixed indexed annuity with the income rider, it's giving you a guaranteed payout for the rest of your life, no matter how long you live. That principal is going to get drawn down over the time that you're taking those guaranteed paychecks. And let's say you pass in year 1, well, your beneficiaries are going to receive the principal that you have. But let's say you pass in year 20, you've already drawn down all that principal. There's nothing left to give your beneficiaries. So there's not going to be anything remaining. Those are going to be the main differences when we think about retirement income using a MYGA strategy or a fixed index annuity strategy with an income rider. And I want you to consider here, it's not about which one is better, it's about which one fits your income goals. There are different reasons in each and every person's portfolio to use various safe money strategies when building your income floor, when adding supplemental income, when protecting yourself against the risks as you age. Some people like to do annuity laddering where they might have a portion in a MYGA, they might have a portion in a growth annuity or a portion in an income annuity that could help you with inflation hedges. That might be turned on when you turn a certain age and you know you want to go on trips for several years. Or let's say for long-term care, maybe you want to ladder MYGAs in a certain year as you age, turn that one on for long-term care protection. Perhaps you know you're going to have grandkids at a certain age and you want to then stop working your part-time job and you want to play with your grandkids more. So you want an annuity turned on for that. If you go back to my lesson with Tom Hegna, he shares at the time of that recording that he has 13 annuities and he ladders them for various reasons. So in this lesson, I just wanted to help you understand some variations on how you could use a MYGA or a guaranteed lifetime income annuity to supplement your retirement income using safe money strategies. Recapping, which one fits your plan? A MYGA, simple fixed growth, no fees. Income is the interest that you're earning, and it's ideal for a safe guaranteed yield. A fixed index annuity with an income rider is going to be market linked growth. There's a rider fee for that guaranteed lifetime income. The income is going to start typically in a fixed index annuity. You're going to defer it for 1 year or more. And as you defer it, the income will go up and up and up. And you really want to access these for guaranteed income for life. This is about longevity protection. It's about creating your income floor. It's about feeling comfortable to spend money in retirement, knowing that your other buckets of money can continue to grow because you've got the floor set. It's guaranteed and you don't have to worry. I've had a lot of clients come to me who have high net worth and they're scared to spend their money because they don't know how long they're going to live and they don't want to pull from their equities. So annuities are a great fit here because it just keeps coming and coming and coming every single month and they don't feel like they're drawing down their assets that they have growing. If you want to see if a MYGA or an FIA fits your plan, go to retirementincome.school, click on the book a Q&A call. We'll have a chat about your unique situation and we'll create a personalized solution for you based on your retirement income goals. And if you haven't yet subscribed to the Retirement Income School podcast or YouTube channel, be sure to do so now. Turn on the notification bell so you never miss out. Give us a thumbs up, leave us some reviews. It helps us reach more people. And be sure to come back next time to the Retirement Income School, where you'll learn how to keep your money safe and make it last so you can enjoy retirement. This content is for educational purposes only and is not financial, legal, or tax advice. Always consult a qualified professional before making decisions about your retirement.